Welcome, everybody. I'm Peter Spina. I'm the Business Supporter Officer at NADF, and today we're going to go over financial empowerment. So, looking at the agenda for everything today, we'll be topics we'll be covering is financial empowerment. What does it look like, and what does it mean? Financial institutions, account types, and financial goals. Now, I do want to kind of set a tone for the session. It's not about being perfect with money. It's not about knowing how much you earn, what you own, the mistakes you've made. It's more about understanding how money works so that you can make decisions based on a more informed knowledge than just kind of winging it. And if at any point you feel like you learned something you didn't know, that's an awesome kind of win. And that's kind of the space we're looking for. Just off the bat, you know, financial empowerment isn't something that's innately born in us. It's kind of something we learn. Some interesting stats are 70% of people who end up winning the lottery do end up broke. 78% of professional athletes end up broke within 3 years of retiring. So it's not always just the money that you earn, it's kind of what you end up doing with it and knowing where it's all going. And if you do have any questions at any point, you'll feel free to put it in the chat and I'll get to them near the end. So, with that, financial empowerment, what is it? It's the ability to understand, manage, and make decisions about money. It's knowing enough to make those informed choices. It helps you understand where your money goes, how financial products work, and the long term impacts of everyday decisions. It's never about being an expert or being perfect. It's about having a good understanding to make informed decisions and knowing who to go to for questions and avoiding costly mistakes. Why does it matter? So, when people don't understand money, it often leads to stress, avoidance, or feeling out of control. When you do have that empowerment and that understanding, it helps you understand money. Um, you feel more confident that you're able to make better decisions instead of just reacting. And you end up being less anxious even when money is tight. So just looking here, so with control, so money stops feeling random and overwhelming. Having that empowerment gets you a better idea of when the money is coming in and what everything is being assigned to. So it doesn't feel like you're just living a paycheck to paycheck kind of life. Confidence, when you have a bit more understanding of everything, you don't put off paying those bills or feel like you don't have any kind of conversations about your finances, and reduces stress. So knowing where your money goes and what you're putting aside helps you have less anxiety, and knowing that you have money set aside for those times that money is tight really helps you out, kind of gives you the options and not necessarily more money when you have that kind of empowerment. So common myths and mistakes. A lot of times people will say I'll deal with it later, but that tends to lead to high leads to additional fees, debts, and missed opportunities. So when you get that bill and you're not paying it right away, you might say I'll worry about this later, throw it on the kitchen counter, not worry about it. But there are fees that do come up when you're not paying everything on time. Thinking that you're bad with money is a skill. It's not something that people are born with innately. You kind of have to learn those skills along the way. Thinking that budgeting means restricting. A lot of times people think if I'm doing a budget, I'm only allowed to spend these things on these certain aspects of my life, when in reality, it helps you open up to what you actually can spend and lets you have a bit more clarity of knowing where your money is going. And then I need to earn more money before I can actually manage my money. So having the proper habits in place before you end up learning more and having a lifestyle creep come up is a lot more, it's a lot easier than just trying to make more money and not dealing with the issues at hand. So you don't need to be rich, you just have to be informed. So, how do I learn to be more financially empowered? So, there's a lot of places you can go and learn. It's not ever from just one spot. So, personal experiences, it's always easier to learn from your mistakes. I mean, I know when I was 25 years old, got my first full time job, I thought it would be smart to buy a house and also pay for personal training all at the same time. Uh, I didn't have a budget, so I slowly was spending more than I was making, putting myself into debt. From that experience, I kind of learned how to budget and understand how much money I can actually spend when I have um, payments every week or every month. Going to workshops, presentations, things like webinars like this, reading books. There's a lot of good books out there. Psychology of Money and Finance for the People are two very good books to kind of get your sink your teeth into. There's a lot of podcasts out there. So there's a Canadian one called More Money with Jessica Morehouse. She's a on the road to becoming a qualified financial planner, and she has a lot of great guests on there on how to manage money. Subscribing to financial content. So there's a lot of content creators out there on YouTube. Some of them are like Dave Ramsey or Caleb Hammer. They've got um, YouTube channels that they have people come in who talk about their financial issues and they try to help solve their problems. And then just talking to professionals. So there's people at the bank who can help you out. There are qualified financial planners, there's accountants, there's certified financial planners. There's a lot of people out there who have the knowledge, and just knowing who to go to along the way can help you in the process. So now we're going to take a quick look at financial institutions. So the three major ones are banks, credit unions, and financial service platforms. So your banks, these are your TDs, your Banks of Montreal, your RBCs. So these are all for-profit institutions owned by shareholders. So basically, the interest and that they make on giving out loans and mortgages, that money goes back into the bank in order to show higher to make money, so that the shareholders who own parts of the bank, their shares in that company go up. And kind of what they offer, so this is typically where you'll get your checking and savings accounts from. They offer credit cards, loans, mortgages, and there's a lot of branch access. So when you're going to a bank, you go into a city, more likely than not there's at least going to be one of your bank at that location, which you can go to take out money. And there's often ATMs there as well, so you can just pull out your money there when you need it. Credit unions, so these are similar to banks, however they're not for profit and they are member owned, so they tend to be more community focused. So the people that use these bank or use these credit unions are also the owners of it. So the money that these credit unions make go back into the union, which allows them to offer better rates on their loans and also lower fees for the accounts that they have at the credit unions. The financial service platforms, so these are places like Wealth Simple, where everything is online and app based. There's not really a physical location that you can visit or an ATM that you can use to pull out money from. You can use the automatic bank teller machines or ATMs at other banks, but there's also often fees associated with pulling out money from there. Because they don't have physical locations, they are able to offer lower fees on their accounts and have a slightly higher interest rate on their high yield savings accounts. So, the types of accounts that are out there that you can use while you're at a bank tend to be checking accounts, savings and high interest savings accounts, the tax free savings account, which is referred to as the TFSA, the registered retirement saving plan, which is called the RRSP, and there are a few credit products out there as well. So a checking account is typically designed for money movement. It's not somewhere that you place your money in order for it to grow. It's more for it to be moved. So this is basically the account that you would receive your paid pay deposits in, that you might be paying your bills from or doing any purchases with your debit cards. They tend to have monthly fees associated with them in order to have them. And there's also usually transaction limits. So you can only send out so much money in a month or transfer money from your one account to another so many times in a week. The place you would tend to want to put your money in for savings tend to be savings accounts or high interest savings accounts. So this is more for money that you don't need to be spending on a day-to-day basis. This is money that you're going to be putting away for an emergency fund or any kind of short-term goals. Now, a emergency fund is a kind of savings account that you put aside for if you have an emergency you can pull from. It's not money that you will pull from on a day-to-day basis. It's just there to have if there's any kind of emergency, like maybe you need a new tire or the fridge breaks. It's money there ready to go. That way you don't have to put it on a credit card. And high yield or high interest accounts help you grow your money passively. So they have a slightly higher savings rate than a typical savings account. Typically, they're anywhere from like 0.5 to 1%. You can find some higher here and there. It just allows you to grow your money without having to actually invest it, and it stays and is ready to go when you need it. And it's a good idea to keep your savings money separate from your spending money. That way, you're not pulling in and drawing in from your savings accounts. The tax-free savings account, also referred to as the TFSA, is a savings account that was started in 2009, and it's designed for you to grow your money tax-free. So the money that you put into the TFSA, and if you were to invest it in stocks or an ETF, as that money grows, there's no taxes on it. And when you withdraw from that account as well, the money that you earned doesn't get taxed. It's designed for you to put your money in, wait till you retire and pull it out, and then you don't have to worry about paying any additional taxes. And then each year there is a annual contribution limit. So typically, I think in the last couple of years, it's been between $5,000 or $7,000 each year. So every year past the year you turn 18, you get that additional contribution room. So if you were 18 in 2009 or older, over the last, what is it, 17 years. You have a credit, or you have a limit of $109,000. And if you end up making a lot of money in that account that is over that $109,000, if you were to pull it out the next year, once you're allowed that contribution back room in, you get the full amount that you had taken out plus whatever is in set as that limit for the next year. Now, for the RRSP, or the Registered Retirement Savings Plan, this is similar to the TFSA, which are both designed to help Canadians save for their retirement. The only difference with this one is that the contributions that you make to this account are tax deductible. So with this example, if your taxable income is $50,000 and you put $5,000 into the RRSP, your new taxable income is $45,000, which if those were two amounts in different tax brackets, you'd be paying less taxes while you're making the 45. Now, the only difference, or the other difference with this program, is that it lets you grow the money tax free, but the moment you withdraw it, it becomes becomes taxable, because what you're basically doing is deferring your taxes until your retirement, when you're typically not making as much as you are while you're working. And it's also taxable if you withdraw it early. There are penalties along with doing so, because it's kind of designed to help you save for your retirement. Now, credit products. So these are things that you can kind of usually get at a bank. So credit card. So this is short-term borrowing. If you know you have a payment, or you want to purchase something, and your money is coming in a couple days, you can kind of put it on your credit card. Or if you have the money in your bank account, you just want to use your credit card because it's more convenient and you're able to get rewards and points from it. You can go ahead, swipe that card, and then just put the money that you've saved from in your savings account, put it towards the credit card. There are also lines of credit. So these are often given to you from a bank, and they have lower interest than if you were putting it on a credit card. There's still payments that need to be made. Both of these are great if you have an understanding and use them wisely. It's not free money. These are things you do have to pay back with interest. So whenever you're pulling something from one of these cards, typically, if you're not paying it off within the first month, there is additional costs that you're paying for using these convenient products. So just to kind of match what account is useful for which goal, the day-to-days are great. Your day-to-day use is basically good for your checking. If you want to have any kind of emergency fund, this is where you're going to put the money into a high interest savings account. For your long-term growth and retirement, this is what you're going to want to look at putting towards for your TFSA or your RRSP. And then for short-term flexibility, as long as you're using it intentionally, this would be your credit products. So needs and wants. Your needs are something that you have to spend your money on. So rent, mortgage, groceries, utilities. A phone is also a need. Your wants are the things that you don't necessarily need in your day-to-day living, but they're the fun things you kind of want to spend your money on. So that's going to the movie, buying a new phone. If your current phone works, there's no real need to get that new one. And even dining out is considered a want. So, why knowing what the difference is between the both of these is important is because your needs need to come first when your money is limited, and your wants aren't, they're not bad things. It's just you need to make sure your needs are covered first and have kind of boundaries surrounding those wants. And having an awareness between the two helps prevent overspending, especially when you're starting to plan out a budget, which we'll cover in next week's webinar. So once you kind of figure out what you're buying, what are needs and what are wants, you can kind of look at setting up your financial goals. Now, financial goals help you achieve things with your money. So determining your goals help you kind of determine what you're going to be doing with your budget. This could be things like saving up for a trip, buying a house, or paying off credit card debt. Typically, there are three types of financial goals, and they are short term, midterm, and long term. Your short term goals are typically a year or less. So this could be building an emergency fund or creating a budget or even learning to be more financially savvy. Your midterm goals are anything between a year and 5 years. So this could be saving for a down payment on a house, purchasing a new vehicle with minimal or even no financing. And then your long term goals are anything more than 5 years. So planning for retirement, trying to pay off your mortgage early, or even doing estate planning. And kind of knowing which goals are most important to you will help you figure out where majority of your money is going. If you're say 19, retirement is very far away, so you don't have to put that much away each paycheck, but you might want to start saving for a house. So more of your money would go towards a down payment on a house than saving for retirement because your timeline for retirement is so much longer. With your financial goals, when you're trying to set them up, there's six kind of steps that you kind of want to look at. So you want to figure out what's most important to you. So again, that timeline is going to be important. If you're younger, retirement's going to be very far away, so you don't have to be putting as much in. Maybe you want to go on a trip in a couple of years or even a couple of months. That was really important to you, so you're going to want to set that goal more than your others, and then sorting them into how quickly each one is achievable. So again, you want to go to Cancun for the summer, how much am I going to have to be putting away each month in order to hit going there? You're going to want to apply a SMART strategy, which we'll speak about shortly. Then you're going to do the development of the budget. And then once you have an understanding of what you have to spend, you can kind of come back to what you've been working on for your goals, do any kind of edits that you might need, and then work from there. And then once you have those goals ready to go throughout the month or even the full year, you can kind of monitor the process or your progress to kind of see if you're hitting those goals. And it is also important to kind of write them down, because that way you're able to, if you write them down and stick them on like a sticky note, put it on the fridge where you're going to see it a lot, it's going to be on your mind. So then you're going to kind of focus in on those goals instead of just saying it and then it's just out there in the breeze. So with the SMART strategy, SMART basically means specific, measurable, achievable, relevant, and timely. So specific, how exactly are you going to be doing this? Or what exactly are you doing? Measurable, how are you going to know that you're achieving your goal? Achievable, is what you're trying to do realistic? Relevant, does it matter to you? Like, why are you doing this? And then timely, so is this going to be accomplished by? So in here, here's an example of a SMART goal. I will pay off my $6,000 in credit card debt. I'm going to be doing this by making monthly payments of $500 a month until that balance is zero. I want to have this paid off within 14 months. So having that goal and then looking at it in your budget to see if it's realistic that you can in fact put that $500 a month towards paying down that debt. This would be considered a fairly smart goal. Now, while setting your goals, there are things you're going to want to think about as well before going into those vacations and retirement planning. So those things are having an emergency fund, paying off high interest debt, investing for retirement, and big life stuff. So the first thing that you're going to want to think about is having that emergency fund before you start saving for a lot of your goals. It's good to have 3 to 6 months of living expenses saved up in a bank account. That way, if anything happens, you can sleep at night because you know you have the money there to help cover any costs. If maybe your car needs a new engine or something, you got that money set aside, you're ready to go. That way, you don't have to take out any loans from the bank and having to pay interest on that as well. So all of a sudden, you're spending the money and paying additional funds as well. Paying off high interest debt. So typically, this is going to be like your credit cards. Anything over 7% is considered high interest debt. So, having $5,000 on a credit card and the interest every month you're paying is like, say, just quickly it's like $200, then that $200 plus your 5,000 continually adds on, so you're paying more. And typically, if you're investing money, the average is 7%. So if you're making 7% on your investments, but you're spending like more than 7% on paying off your interest, you're not actually making any money, you're still losing it. So having all your high interest paid off first helps you save more in the long run. And then investing for retirement. So if you're working at a place that has employee matching benefits, take advantage of it, because most places will do like up to 5%. So whatever you put in, they're matching you 5%. So you're basically investing 10% into your retirement. So you always want to take advantage of that. And then still, again, think of those big life things. Once you've got these initial three taken care of, then you can kind of go in, look at the house, look at the car, look at that trip. And how goals guide decisions. Goals help answer, should I spend this? Where should my money go first? And goals turn budgeting from a chore into a purpose-driven tool. Now, I did kind of breeze through that a little faster than I had assumed. So it does bring us to the end of the webinar. Are there any questions? Doesn't quite look at it. So typically I would spin a wheel, but Steven, since you're our only attendee, you will win a $75 gift card. I have your email, so I will get someone to get in touch with you to help set that up. And with that, that's the end of the webinar. Next week will be the budgeting one. So thank you so much for attending and have a great day.